Welcome to Essex University. Thank you for joining us at our webinar today. Our webinar today is under our Space to Grow Investment Readiness program, where we try to unravel and to help explain the intricacies of how to go about investment funding for your innovative project. We have a couple of eminent speakers today, but first of all, I'd like to take you through some basic housekeeping. This webinar is being recorded and will be made available on YouTube later on, once it's been edited and highlighted. And the actual program itself is part of a university funded and Research England funded program to help encourage Essex businesses to grow and develop, to help encourage Essex investors to invest in businesses, but also to work with international investors and innovative businesses from throughout the country who are looking for that magic touch to their businesses, that X factor that will enable them to grow rapidly and to make a significant difference, be disruptive in the industry going forward. Now, today we have two good speakers. We have William Millar, who has a long-standing relationship with BT, developing their products and services on the innovation side, and has recently been the innovation advisor in Norfolk and Suffolk for the New Anglia Growth Hub, and has a very good track record being a fellow of the University of Belfast in helping businesses understand and unravel innovation within their organization. And we also have a special speaker, Nitin Patel, who has a background in automotive and industrial, and more recently working with St John's Innovation in Cambridge, identifying innovative businesses that need investment and helping them find that investment. So with our two eminent speakers today, there is a lot of information, a wealth of information that you probably would not gain elsewhere, but delivered in a very sensible way and very understandable way. So as I said, this forms part of a program. We have another webinar at 2 o'clock tomorrow, which is on VCs versus angels, delivered by Michael Berger from BDO, one of the leading accounting firms, and their program of developing growth in innovation is one of the leading programs in the country. I look forward to those of you who wish to join us again tomorrow. So I would now like to introduce William Millar, who a very eminent professor, Dr. William Millar, I should say. And please, William, would you like to share your screen and take over? Oh, before I start, why don't we do a little poll? We'll be doing some of these throughout the seminar. And it's interesting for us to get your views. Your views do count. So, Josh, would you like to run the first poll, please?
Yeah, so the first poll for today is, have you already decided on your investment strategy? So if you just vote on the buttons there, so yes or no. Okay, and we're in that one there. Thank you very much, everyone. And we can share the results now. So as you can see, so the majority of people in this webinar haven't yet decided on their investment strategy, which is good. So hopefully William and Nitin will be able to give you some key tips, key advice to help you actually put together your own investment strategy.
Thank you very much, Josh. We will be running more of these polls during the course of the seminar, so pay attention, please. William, would you like to take over? Thank you.
Okay, thank you, John, and thank you everybody that's on the webinar for coming along to hear us speak this afternoon. In that we're going to look at what we view the key contents of a pitch deck as being, so that it will entice the investor to come along and speak in more depth to you about your business opportunity. The pitch deck is really the first point of contact between you and the investor. So you want that to have as much information in it as the investor would need, but not too much that it swamps them with all of the detail that could come later. If you look at Dragon's Den, you will have a view that a successful entrepreneur turns up, does a few minutes of speaking, answers a few questions, and then the dragons all reach into their pocket or reach onto the table beside them and hand them out a lot of money. Well, in real life, it doesn't work like that. The pitch is really just the point of engagement between the entrepreneur and the investor. And after that, a lot of due diligence takes place to make sure that that is a good investment opportunity. So we're not going to talk about the due diligence phase. We're really just going to talk about the pitch deck itself and getting that first engagement with the investor. So this is the agenda for this afternoon. The first question really to ask yourself, is equity investment right for you? Before you delve into doing a lot of work to get that investment, really make sure that that's the right thing to do. And then we'll take you through the contents of the pitch deck, and we'll summarize that at the end and allow you to ask questions at the end as well. So really, looking at equity investment, what does that mean? It means that you're selling part of your company in the form of shares. That's really what you're wanting to do. And an obvious statement to make is that you must have shares to sell. So your company structure has to be right in order to have those shares available. So certain company structures do not have shares available in the company itself. So make sure you've got the company structure right, and make sure also that you've got agreement to sell shares from the other shareholders. Now, when you get investment, it brings others into the company, and that means you've got a different relationship and a different dynamic there. Usually in the early stages of the company, you're looking for an angel investor. An angel investor is somebody who can bring some expertise to the business and help you with that business itself. So be prepared to listen to those investors. It's not just you that's dealing with the company anymore. You have a responsibility to your investors, and you'll have to communicate with them and keep them up to date with what's going on. Even if you get a passive investor who doesn't want to have too much participation in the company, nevertheless, you'll have to keep them informed. So be prepared to do that. Investors are coming along, and what they're really looking for is a return on their investment. And you can ask them what they're looking for, but typically it'll be something like a 10 times return in 5 to 7 years or less. And so you need to ask yourself, can you and your business support that return that they're looking for? So be aware too that other forms of investment are available. It's possible to borrow money. As a startup business, you would probably be eligible for a startup loan. There may be some form of grants available to you. Startup businesses usually find it difficult to get grants because they don't have a trading history, but nevertheless, in some specialist areas, there are grants. So look out for those as well. And just one word of warning to say that seeking investment is a journey. It's a long journey. It may have bumps along the way. So be prepared to undertake that journey and be prepared for those bumps as well. So right at the very start, I said that we would be, when you're looking for investment, it means that you're selling part of your company in the form of shares. That means your company has to have some value. So we are now going to run a poll to see how many people have established a valuation for their company.
Okay, and we'll leave it there. And so I'll share the results again with you. So you can see the majority of those in the webinar haven't yet established a valuation for their company. And I'll hand back over to you, William.
Okay, well, I'm now going to hand over to my colleague Nitin, who is going to take us through an overview of what should be in the pitch deck, and then we'll go into each section in more depth.
Thanks, William. So as you can see from the slide there, that there's a process that has been developed, which generally is pretty familiar to everyone in this sort of space where they're talking to people who want investment, and investments are sort of looking for specific things in a deck. What we've done is highlighted 11 key points that we feel are necessary to put into that deck, starting with the problem and ending with where you are today prior to seeking the investment. Now, this is one of the key starts to the deck, the problem that you're looking to resolve. And in this case, this has to really show the uniqueness, the understanding you have about the problem, and then being able to describe it in a concise manner that it is easily for someone else who's only going to look at your presentation for maybe 10, 15 minutes maximum before he decides that he wants to talk to you. So even though you may understand the problem, it's very important that you see it from the other person's eye when you're describing it. The other thing that's very good in this is if you're part of that industry that you're looking to solve the problem in, that gives it much more credence when you're trying to solve that problem and have a good understanding of the industry. The other thing that works quite well is if it's a problem that you've been associated with. So make sure that if it's something that you've lived with and have to solve for yourself, then use some of that history because that makes it all real. Bill, have you got anything further to add?
I think for me, the key thing is the making sure that you can get the problem stated in a concise way such that anybody can understand it. You may be working in a very technical sector, and you may be lucky enough to get an investor who has got technical expertise in that sector, but quite often you'll find investors aren't specialists and they are lay people. They're looking for a return on their investment. So make sure that you can state the problem in such a way that anybody can relate to it. And if you can put it in the context of an end user, the person who's actually going to use your solution eventually, then that's a good thing to do as well. And for me, whenever you state the problem, what you're doing is actually identifying the market that you're aiming for. So whoever has the problem could be an individual, or it could be people in a specific sector of industry. So that's going to give you a clue as to the marketing that you're going to have to do, the market sector that you're going to reach, and all of that information is coming out in the problem statement. So I'll go to the next slide.
Okay. So the solution statement. Now this is a key to actually the interest you will sort of get from investors. So once you know the problem, the solution has to stand the stress test. And what we mean by that is it certainly needs to be unique in a sense that you're bringing to the party something that hasn't necessarily been thought of or even been used in that context. It certainly needs to be clearly defined because this is an area where a lot of the investors could come with interest. So they may know about this area, particularly if they're from an industry that's specific to what you're trying to do. So it's very important that you can clearly get the problem statement across to the person who needs to understand it. And in this case, it's actually the investor, and it can really be the make or break of it because, you know, the solution is what's going to be invested in, and the solution is what the investment's all about as well. So, you know, stay clear. I know in a lot of technical areas, there's a lot of technical jargon that is used now, but also remember that the investors will come from a wide range of backgrounds and they won't all be of the same sort of status in terms of knowledge of the industry. Bill?
So a couple of comments I would make at this point is that the solution is obviously complementary to the problem statement. So it's an obvious thing to say, but does the solution solve the problem? Now, it may be that the solution doesn't solve the problem right away in its first go. You may be developing something which is going to take one or two releases, particularly in software, in order to solve the problem that you identified at the outset. So it's important eventually in the deck to make people aware of that. But in stating the solution, what you're also doing is opening the door to a lot of other questions that will come up, particularly the why questions. So why questions could be, why is your solution the best? Why are you best placed to deliver it? Why now? Why does this solution work at this point in time? Why will people buy from you? So you need to be able to understand that those questions will be going through the investor's mind at that point, and they will eventually ask them. So you be prepared to have good answers to those questions when they come up. And really, the solution statement is the framework on which everything else is built, because the solution is what you're offering into the marketplace, how you get it to the marketplace, how you make it, how you sell it, and all of that will flow from the solution statement.
Right. This is one of the key slides in your presentation, because everyone is keen to maximize the investment, but on the same basis, it has to be balanced. It has to be realistic. The approach has to be such that, you know, what the problem you've defined and the solution fits the sort of investment you're looking for. It should be clearly stated how much you are looking to sell. Is it 5%? Is it 20%? And also, in terms of valuation of the company, it's important that you sort of get that from a number of places. So if there's a question asked about why is it valued at certain value, then you can get reference to a couple of places rather than just one. And it is very important because what you sell is based on the value that you think the company is at the time of you wanting to sell it. And there's a number of ways that people look to value companies, and some of them are overpriced, some of them actually are underpriced. So that is a balance, and it'll also be a conversation that you will have with your investor as you get to discuss in depth what you're doing, why you're doing it. So be clear that you have a clear understanding of what you're saying the worth is, and I've done some due diligence on some experience of why you think it's that, whether it's a comparison with someone who's on the market, or whether it's a solution that is like something else. So you really need to be very key in understanding the value of your company at that stage. The other thing is you need to sort of make clear, is this your first round? Is this going to be a number of times you're going to go back to the investor? Is there a sort of differentiation between the first investors and the second investors? And that type of thing is very important. Now, this is a little bit more in depth than this slide shows at this stage, but it's a point of starting the discussion in a realistic manner so you get into those conversations with a potential investor. Bill?
So the thing to also to be concerned about is it this going to be your only round of investment? So there's two schools of thought on that. One is go and raise as much money as you can because it's going to cost you in terms of overhead to raise all of that money. The other one is to raise a few rounds of smaller value. Now, the downside of that is that it will take time. In the early days of the company, it's usually the founder and their partner, the co-founders, who will be doing everything in the company, including raising the money. And if they're taking time to raise money over a number of rounds, then they're not devoting effort into the business itself. So that's something to concern yourself about, how much money you're going to go for and how often. And the other thing is to look for investors that are bringing perhaps expertise into the business itself. And what are you looking for in terms of that expertise? Are you looking for their black book of contacts? Are you looking for sales leads from them, introductions to other companies? Are you looking for their networking ability? So there's more than just money involved in it. There's also expertise and other benefits that the investor can bring. So do some due diligence on the investor themselves to see what they can offer you, and don't be frightened of asking them, what can they bring to the party as well.
Okay, so once you've got to that stage where you've understood, that you need someone to invest, you've got a great idea for someone to invest in, and then you're asking for the money. And this is really important, particularly at the stage of the discussion as to how this will help you grow that business. And it should be clearly defined as to where most of that money is going to go. It needs to be clearly sort of understood that everything that you will spend is adding to the value of that company, and the investor is looking for the investment to sort of increase his value by up to 7 and 10 times what he's looking to invest. So make sure that when you actually are looking for the investor and telling him where the money is going to go, you've done some work in a fair amount of detail. I mean, you can't know all the answers, but in a fair amount of detail to show exactly where that money is going to be spent. It's also important that you don't sort of just say, you know, some of it we've been doing for 4 years and all of a sudden we're going to take a salary, and also show that, you know, if there's things you can do, then you're doing them. So if you're a coder, then make sure you do a lot of the coding yourself until you reach a stage where you can't do it yourself because of the volume or the technical knowledge. And that always helps investment, because then they're buying into your skill sets, which is always good.
The other comments I would make on that is that sometimes we see decks where people ask for money for salaries for people in the team, and there's nothing wrong with asking for money for salaries in the team, but it's much better presented as we are on a journey to grow this business. We've got this roadmap of things that we want to do. For example, we may have a platform that we want to develop, and in order to develop that platform, we need developers, and that's why we need money for salaries. Or it may be that we've got a very good marketing plan, we've got to reach out to a number of people, therefore we need people with marketing skills, and therefore we need money to pay for the salaries of the marketing people. So think of it in terms of what the outcomes are from that investment that's going to be made, and don't sort of blankly state that we need to hire four people at £30,000 per annum, so therefore we need 120k. We are going to develop this application, we're going to do this marketing, whatever, look at the outcomes and work backwards from that to point out what it is that you need. And you should also be prepared to defend everything that you've put down there and see that it is absolutely necessary. You know, so the way COVID has worked is it's made lots of people work from home. So therefore, in a lot of knowledge-based industries, do you actually need an office and accommodation like that? So questions like that you need to think about as well. Be prepared to justify everything that you're asking for.
Now, this is one of the key areas for you to sort of show your knowledge about where your solution of a problem is going to fit. The market opportunity is what attracts a lot of investors. So the bigger the market is, the better. But on the same basis, it's very important that we don't use percentages to show how big the market can be for a particular project. What I would say is there's a tradition set in this field of how to define the market and sort of reach the segment that you can work and you can sort of offer a solution to. But the key is actually you getting to understand that market a bit more in depth, and then being realistic about how you can achieve a segment of it. So on the one side, it's easy to say, you know, a big market, a small percentage means a big potential revenue opportunity. But some of that doesn't look realistic when you put it to investors as a first stage. So I would really look at that. You have to go through the process, because it's very important that you sort of have an opportunity that fits into a very wide market. Sometimes the markets differ from country to country for the same sort of project. So you need to be knowledgeable if you're going to talk about an international opportunity of understanding the differences between the markets. The other thing is, whatever you think it's going to take to break into the market is normally a lot longer. And that could be from the fact that either you didn't sort of know the whole in depth of how hard it would be to engage with the industry, or it could be that, you know, you've got certain things that delay. So be sort of realistic in timing of when you start looking at achieving your first revenues and that type of thing. Bill will talk a bit more about the depth of to get to the numbers.
Yeah, I come from, I'm an engineer by trade, and whenever I see percentages of markets, it always sounds very abstract to me. So I'd really like to know, you know, how is your revenue going to be built up? So things like working out who your ideal customer is, and then how many can you find of those ideal customer types in the geography that you're going to operate in, gives me a view of how many people I can sell things to, and then how many businesses or retail end customers are similar to the ones that you know about, and can you then have enough resources to sell to them? Do you have enough ability to sell to all of the people that you can identify? Now, that may be a difficult task to find out how many customers there are, potential customers there are, but there are lots of people about who have databases that you can access, some of them for free, some of them through the enterprise agencies, the likes of Menta and NWES and Colby locally, and some of the other bigger database providers like Experian or Bohurst or whatever. So use that to find out some data that will help you understand what your likely opportunity is to sell to people. And then once you've identified that, you know, what your business is about is selling something unique into the marketplace. So you've got to understand, well, how long will that market last? How easy is it for somebody else to enter and start to eat the, you know, my lunch that I've created in my business? And what will disrupt that market as well? You know, if you've got something that's successfully selling into a marketplace, what's the new thing that will come along? So that gives you an idea of the lifetime of the business as well, before it has to change and do something else or modify what it's doing. So I like to see a bottom-up build. You know, how many customers can I identify in the region that I'm going to operate in, to complement the top level view of the percentage of the market that I can take. Okay.
The slide following the market is obviously the revenue projections, which are quite easy in a sense to sort of predict, particularly if it's a sort of single market that you're going into. But the challenge is really achieving them. So it's very, very important that you actually look, going from the discussion before, that you have really understood where your opportunities are through the market analysis, and then realistically pick one or two key areas that you're going to concentrate within that market to get your first opportunity of turning revenue. So it's always tempting to say, I can do lots of stuff around once I've got the project up and running. But realistically, that's when the challenge starts, because the hardest thing in business is taking someone else's money for something you are going to give them. And, you know, creating revenue is exactly about selling something. So that's one part of the challenge, to say, you know, what you're going to gain from the market with your specific solution. But the other thing is also being realistic, because if you say you're going to go from £1 million to 10 in a year, that means, you know, you're going to have to do certain things within your business 10 times more in a simplistic way. And can you do that, particularly if it's a people business? Because recruiting people, training them is always a harder thing than people sort of think they can achieve. So be realistic. And, you know, if that's the constraint in some cases on achieving maybe the revenue that you have the potential for, then be realistic at that stage, because the investor may be able to help you with his experience, or they may say, you know, why don't we take more revenue or more investment to speed things up if it's all real, and the actual ability to run at speed is there. So ensure that whatever track you're trying to follow in terms of revenue generation, you're able to scale up to those requirements from the services or the products or whatever you're planning to deliver. Bill?
Yeah, I think for me, the key thing here is being realistic, so suppose, for example, you say you're going to achieve revenues of £300,000 in year one, and each customer spends on average £1,000. That means you're going to have 300 sales in order to get your £300,000 of revenue. So that's 300 over 50 weeks, which is 6 sales per week or more than 1 a day. So can you do that? Have you got resources to do that? So do some, back of the envelope calculations that gives you a handle on how real your revenue projection is. And if you can build that into a model, a very simple model on Excel that will bring in other considerations like churning customers and new entrants and competition coming in, so that will dilute your ability to sell to other people. That's a good thing to have that you can use as a discussion point with an investor.
Okay, so to create the revenues, you obviously need to market yourself and then sell into that market. One of the hardest things to do is really engage with the customer. So marketing is about understanding the industry you're getting into and how they will want you to engage with them, whether it's through people, whether it's through social media, that type of thing, to really get to grips with getting people to know your projects, your solutions, and your business. On the other side, it's always very hard to convince investors, particularly if their revenue costs, that marketing is something that you want to be spending heavily on at an early stage, because it's money that's used. You don't have anything for it in terms of physical assets. So it's a challenge, but it's not something that we recommend you shy away from. It's something that a lot of startups, depending on the team, sometimes don't have the ability to communicate properly the things they need to do. So this is an area where, if you're a technical based startup, then it's somewhere that you may have to go and find the resource to help you. Be very sort of prudent about finding people who can help. Be very specific about, the sort of things you want to market, and don't get overawed by someone giving you some real nice slideshows to say, we can do this for you, but then end up spending lots and lots of money for something you can't really measure. Yes, there is an ability to measure in terms of engagement and how many people view something, but at the end of the day, the real measure is how much money do you take from a customer. So it all depends on the product, the market you're facing, the sort of people doing business within that industry. It's really great if you can sort of really relate to the people. So, as we say, some of the younger people, businesses tend to do well in early stages with people of their age, but your business may be looking for a wider age group. So try and get to know a little bit about it. You can't be an expert in all parts of it, but be knowledgeable enough to challenge anyone who's giving you that resource from a marketing point of view. Bill?
I think it's important to remember that although marketing and sales are often quite talked about in the same breath, they're really two different functions. So marketing is a cost to the business. And in the early days of a business, you have to be very careful on how you spend your money from your marketing budget. So quite often people will look for low cost or no cost marketing plans where they can get information out to the people that they want to sell to without spending a lot of money. So look at things that will help you with there, like press releases and getting people to be advocates for you. And try also to understand what your marketing budget is buying for you. So when somebody comes back and contacts you and said, I've heard about whatever you're doing, ask them where they heard about it so that you can begin to focus your marketing on it. Sales is the thing that brings the revenue in, but be wary, depending on what your product is that you're selling or your services that you're selling. You know, if you're selling to large enterprises, it can take a long while to sell to them, and you may have to jump through an awful lot of hoops to get to a large enterprise. Smaller companies may be easier to speak to the MD, but you may find that you've got smaller sales values, so you'll have to have lots of sales to get your revenue up. And then if you're in the retail business, retail customers imply that you're selling in volume, and hence your business has to have low overheads in order to get that volume to create the revenue that you want, or the profitable revenue that you want. So it just depends again on what business you're in. Think about what you've got to do to sell, how long it's going to take to do that, how many sales you've got to make in order to generate the revenue, and how can you scale up to grow the business as a result.
Okay, so this area is really important to understand the value and the sort of traction you would get into a specific market. And it's also about you and how much knowledge you have about the project or the solution you are wanting the investors to invest in. So it's important that you get to know the competition, understand their solutions. You can critique their solutions and compare them. I wouldn't advocate that you are critical to a situation where you're adversely seen to be negative about their solutions, because if they're on the market, then they've already achieved something that you're looking to achieve. So be very careful about the competition and how you review it. It's also very important that if you have IP on a particular solution, that you get to trademark and patent those IP solutions very, very early in the process, because that also gives you a little bit of due diligence on the sense that your solution is unique, and it gives investors some real good feel that the project you are working on or they're planning to invest in. A lot of times these days, there isn't the case that you can get patents on solutions, and hence that you understand the competition out there and really not sort of, I won't say copy, but provide a solution that's already out there. Because don't forget, they already have a market and they can always challenge a new entrant, particularly if it's around cost and similar. So knowing the competition is very important. Understanding what they're doing, how they're doing it, why people are buying off them, that goes around with how they market, and keeping ahead once you do start. So this aspect of the sort of business never goes away, particularly for early stage startups, because so many companies are looking to start up in lots of different areas, that your solution can become very redundant very quickly. And from an investor point of view, they need to understand that you've done enough work in the best of your knowledge that the solution you're providing has got some life.
The other important point to make as well is that while there might be no competition today, somebody seeing you entering the marketplace successfully may be able to quickly pivot from what they're doing to do the same kind of thing as what you're doing. So be aware that that may happen. So keep an eye out for competition emerging as time goes on. And another thing just to say about IP, particularly patents, having a patent doesn't protect you from competition, because what you've got to do is see what they're doing, see if they're potentially infringing what you're doing as and what you've got patented. And then you've got to be able to take them to court or take some action against them if you think that they are infringing your patent, and that can be costly. thing to pursue. So just be aware that patenting isn't enough to protect you. You've got to be able to defend that patent as well, and which will potentially cost money. So some people choose not to have the patent in place. They choose to get into the marketplace quickly and build up market share. And you've got to decide what's right for you. Usually investors look for patents in the business because that gives it some kind of a due diligence check, as Nitin has said, but it also has got some additional value in it. So another poll, which Josh is going to run.
Thank you, William. Yeah, so on that note, on the IP, this one is, have you identified the intellectual property in your company? Yes or no? And again, we'll give it around 30 seconds. Right, we'll end that there. There's some mixed answers coming there. So slightly more people saying that they have identified the IP, but some people still haven't. So I'll stop sharing that now and pass back to William and Nitin.
So if you haven't identified your IP, look at Google for the Intellectual Property Office website, and they give you some useful resources there to help.
Okay, the business model. So this is an area where we get a lot of people who sort of complicate things, and to get the message across, you've got to be able to show that what you are creating is got a value that someone else will pay for. So the model has got to be in a manner that it's easy for the investors to see what you're creating, how you're incurring the costs in creating that, and you understand what drives those costs. You then have to be able to understand the pricing that your product will stand in the market. And that depends on, as we said before, the competition, the sort of marketing you have to do to engage people to work with you, buy off you. So there's lots of different business model, but the thing they have to have is a clear understanding of what you're doing creates a cost. What someone is going to buy off you is going to create the value. And a lot of people get mixed up between the cost and the value because they create something, they have a cost, and there's a very simplistic assumption that they will buy it so you can make a profit. And that really isn't the real world, particularly in areas where, as much as your product may be unique, they may cross over solutions where other people have the ability to do something similar, but not necessarily 100% as good or as equal to you. But does that matter if the value that they're going to get out of paying more doesn't make them feel that they want to pay for it? So it's very important that you sort of understand clearly the difference between cost and what people will value your products at, and the price they'll pay. And at the early stage, particularly if it's sort of making things, then you really work out how you keep the core cost at its lowest. It doesn't mean you have to sell it at the lowest if the market will stand a higher price, but it gives you the ability to be flexible if challenges come from other people in the market. So it's very, and the other thing is, if the costs are based around volume, then it's also important that you understand that the pricing at the early stage would have to be at a place where you may not make any money until you get to a stage where you've got volume. So understanding your pricing model and your business model are very important at the stage where you're looking for investors to engage, particularly at a stage where they need to understand that the revenues you're quoting are realistic. Bill?
I think the other thing to say here is that company valuations will be dependent on usually some kind of accepted multiplier for that industry sector times to multiply up the profitability. Now, how you measure profitability is a subject in its own right. There are various ways of measuring it, but really it's your margin that is multiplied, the difference between your cost and your revenue, that it's that margin that's multiplied by that multiplying factor to give a valuation. So in turn, that's why investors will be likely to drill into this model to understand how much profit you're going to make, depending on whichever way you measure it, and then give them a valuation for the business. So it relates back to the first things that we talked about the valuation that you're going to put on the business, and consequently how much equity you can raise from it.
Right. So we're getting towards the end of the presentation now, and this is where you start talking about you and the team that you're working with. Generally, it's always better to have two founders than one, partly because as you get further down the stage of developing your idea, you need someone to bounce off, and you want to make sure that person is on the same page as you in terms of understanding what you're doing, what you want to do, how you propose to do it, and not feel that it's someone else you're talking to who doesn't sort of isn't on your same wavelength. So it's very important generally that an early stage startup is done with two co-founders if it can help. It's great if you can have supplementary skills, and if both the founders are hands-on, that even makes it a lot better on the one side, because it saves a lot of costs early stage until you get to a stage where the workload is beyond your capabilities, and that helps investors to invest in. On the other side, it also makes you very sort of part of that business, and investors want to know that you're going to be around as long as the business is going to be developing. So it's very important that you find a partner founder at an early stage at this process. The other things are then, as you reach a stage where you grow, is finding people to supplement the team. In some cases, you can sort of outsource bits and pieces of work based on the sort of work it is. If it's work that's tied to the long-term viability of the business, then it may be something that you have to bring in, because development of that part of it needs to be something that the business needs to do continually. So again, you have to assess the needs before you decide. But short term, you can outsource some of the activities. So you don't always have to have a team member for every role at this early stage. What does help is having some good advisors who can point you to the right places for that sort of help, or from their experience, people who would do some of the things that you may need doing. So it's always important that as soon as you reach a stage where you want to take extra people on, that you develop the sort of people that you want to work with. Bill?
I think the only comment I would make here is that sometimes we see slide decks with a list of advisors as long as your arm, and really those are only people that the founder has spoken to maybe once or twice in their journey, but they're included there to sort of say, well, we've got a wide range of advisors that we can call on. And it's, you have to balance that against the investor's view is, well, am I going to come into this, invest money, offer my advice, and then have to fight my way through, a whole host of other advisors who are providing the founder with information. So only include advisors where they're really relevant and where you do have, good contact with them, and there's something that they can bring, some expertise that they can bring that's specific to what you need. And, make sure that any information you put on there is relevant to the business itself. You don't want your 25-yard swimming certificate on, because that doesn't add anything to the business.
Okay. So we're getting towards the end of it. I think there's one other slide after this, but this slide is about where you're up to. It's very important that you tell people at that stage of investment what you've achieved. And, some of the things on that list, we find people forget because they get so involved we're thinking that, we've done nothing. So sometimes when we talk to people, we actually find that they've done more than they think they have achieved in terms of engagement, in terms of delivery. So the way to probably do this is that, as it's listed there in a lot of things, but make sure that what you put on this slide as the status is all current. What you don't want is someone asking you a question and you say that was 3 months ago. So be very specific. This is probably a slide you do in terms of timing when you're delivering it, because hopefully every time you go out and looking for investors, you're making progress along with it in some parts of your business. So keep this always up to date for the investor to show him that this is the snapshot of where you're up to.
The one thing I would add is if you've had any grants, that gives another dimension of credibility to it, because a grant application will have been reviewed by other people, and therefore they will have made a decision that this is a good thing to award grant money to. And grant, a grant is another form of investment. It's not looking for a return back in terms of financial return, but it's looking for something else to come out of it. There could be creation of jobs or something like that, or growth in the economy. So if you've had grants, that's a good thing to include on the deck itself.
Okay, and to summarize, the deck has to tell a story. As we've said, we've sort of outlined a path that we think is practical in delivering that story. You've got to make an impression. So ensure that everything you've put on your slides is checked and it means something, it's adding something. Having lots of things in a deck sometimes can take away stuff. So be careful that you've got the balance right. The story needs to be consistent, particularly the area of sales, marketing, revenue, because that's a story in itself, that you market. As a result of your market, you're going to create a sale, and that's why you're getting revenues. So whatever you're using in terms of the decision-making processes that creates the revenue, it's consistent through that piece. Make sure that the research you're doing is really as wide as you can, because there's no point putting something on there, quoting a place that you've got it from, but it may be the least known place for the information. So it's very important that this summary gives an impression that you know exactly what you're looking for. You've done all the work that's possible for you to understand why your story stands the sort of test. And as we said, this is your final opportunity. So making an impression counts. Phil?
So the key thing for me is making sure that the numbers add up. The investor may not know about the detail of the business that you're in, the product that you're making, the thing that you're selling, but they will know about business and how the money flows through that business itself. So make sure that you know your marketing projections, your revenue projections, your company valuation, all link together and all add up and make a consistent whole of the business proposition. And finally, the thing to say is that you don't have to sell to anyone if you don't want to. That's, look at the investor, look at what they're offering, what they can bring. And if that's not right for you, and your gut will tell you whether it's right or not, you don't have to sell to that person. You can move on and try somebody else. Now, you may lose the opportunity there, but that's a judgment call that you've got to make for yourself. So with that, we'll end and say thank you for attending and listening thus far.
We now have a poll for you. Josh, would you like to run that poll?
Yeah, one more poll for everyone, so it should be on your screen now. So do you plan to alter your fundraising strategy as a result of this webinar? Yes or no there. I'll give you a few seconds. to answer. And we can see the majority of people are going to alter their fundraising strategy as a result of that. So thank you, William and Nitin, for your information that you've just shared. And I'll pass back over to John.
Thank you, Josh, and thank you, William and Nitin. One question that I think I ought to ask is, with all your experience, the combined experience of the pair of you, we're looking at all the opportunities that come onto our Angels at Essex investment platform. What's the most common flaw that you find with these opportunities when they first come to you with their pitch decks? William.
No, it's hard to think what the most common one. I think for me the most common thing is being realistic about what it is that they can achieve in a short term, and that, I think, for me comes from the whole business of working out what the market size is. You know, so you take your total available market and you say, well, that's how big it is, and then you work out how much is available, say in the UK, and then you work out how much of that is available to you, and you work a percentage down and down from that. And that gives you a number, which is going to be your revenue. And we end up with, you know, we can achieve £2 million revenue in the next couple of years. And then you work it the other way around and say, well, hang on a minute, there's only 2 people in the business. You're going to have to make, you know, 500 sales over that 2-year period. Are you able to do that? And then there's a sort of a light bulb moment when it becomes visible to the founders that they're not going to be able to do all of that sales or generate all of those sales in order to generate the revenue. So that's one thing that I find occurring quite often. But yeah, I don't know what Nitin's view is, but
well, I was going to say a similar thing in terms of the expectation of how quickly the business will be into the revenue. But I think that also relates from the background, and a lot of people we have on our platform are technical. So there's a little bit of a link in terms of understanding the market they're going into as well, which I think then leads to this point of saying that's very easy to get in. And I suppose being realistic rather than too critical, they don't also look at the wider picture of how their innovation is going to be seen in the market, because they look at a narrow window of a solution for something they know of. But is there other ways that can be achieved? Particularly, I think today, in the day of digital, there's lots of companies doing similar things in slightly different ways. So they've just got to be a little bit more knowledgeable. But on the other side, it doesn't mean they should not do it. It's just be weary so they're not disappointed too early that it's a long slog.
Yeah, I think that's what, when we're looking at decks here as part of the Angels at Essex team, we try to look at the whole story, you know, the complete rounded story, and not be so what do you call it, fussy about the detail that's in the deck. Don't spend too much time picking holes in each slide, but look at the whole story, and does that make sense as a business proposition, and then work from that down into the detail, into the revenue projections, into the market sizing, and so on. And do those things all make sense, and do they link together? Does it all form a coherent narrative that you could present to an investor?
Thank you. I think with the Space to Grow program that we are running, this series of webinars, which has been proved very successful in the past in encouraging businesses to think ahead and to think in more detail as to what they're trying to achieve. And certainly I cannot emphasize the fact that this is a free program provided by the University of Essex and is available. And please make use of it, because with the expertise that we have available and the research and the facilities that we have available at the university, there is so much that we can help you with going forward, provided that you're prepared to listen and you're prepared to take advice, because they're the two main features that make entrepreneurs innovative, and provide them with the results that they're looking for. I will now actually bring this meeting to a close, and thank you for attending. Slightly overrun, for which I do apologize. Probably my fault for talking too much at the beginning and too much at the end. But thank you, Dr. William Millar, and thank you, Nitin Patel, and thank you, Josh Clark, for the managing the program for us. And I look forward to those who are joining us tomorrow and in the forthcoming weeks as we delve more deeply into the various subject matters and provide you with more help and support in much greater detail. Well, thank you very much for attending. And remember, this video will be available on YouTube, and we will be letting you know when it's available. Thank you.